want to be greedy when others are fearful, and you want to be fearful when others are greedy. It's that simple.
But is it quite that simple? The US stock market, which I invest in, has never been valued so high. We're trading at a record close to 5,500 points. And it's no secret that this is largely thanks to the contribution of the Magnificent Seven stocks: Microsoft, Apple, Amazon, Tesla, Google, Meta, and of course Nvidia, all of which have got the markets excited about the prospects of artificial intelligence. It sent stock prices soaring, perhaps somewhat a little bit artificially.
We got a record high.
Record highs all around.
But can this momentum be sustained? Is the market facing into unprecedented levels of greed, a bubble of sorts which could be the start of the stock market's downfall? Well, if you're an investor, then you better stay tuned for this one. They say history repeats itself, so we're starting off by rolling back the clock 24 years to the turn of the millennium, where the tech bubble-infused US stock market imploded.
It's described as nothing short of breathtaking, a points drop never before seen on the US markets. This closing bell might as well have been an alarm, so savage was the selling.
This is what happened when the US stock market crashed just over 46% across 3 consecutive years, following 5 previous consecutive years of double-digit market returns. The technology revolution had started, and investors were so optimistic about the future prospects of these businesses and the future potential earnings that they could generate that the stock market was trading at an inflationary-adjusted price-to-earnings multiple of 44 times earnings, a multiple not seen in the whole of the US stock market's history. But there is growing concerns amongst investors right now about the current state of market valuations. We're trading at premiums at the 3rd highest point in history at 35.63. These valuations are largely coming from the tech sector, who are all talking about artificial intelligence and how artificial intelligence is going to move their business forwards. So much so that big tech as a sector has far outperformed any other sector across the US stock market. Now, the only other time that the market traded at a higher premium than this was November 2021. And well, the market did go on to crash about 22% from that point, resulting in my own investment portfolio being deep in the red to the tune of about £5,500. But it does make me think about the quote from Warren Buffett, which goes, "Price is what you pay, but value is what you get." And an over-optimistic outlook, which is not met by a continuous growth in a company's or broader stock market earnings, can result in the overall downfall of an individual stock or the broader stock market on the whole. And that's what happened during the dot-com bubble, but with one very specific company in particular, and their stock price still hasn't recovered nearly 25 years later.
You can use the internet to make sure your inventory arrives exactly when you need it, and each customer gets their order exactly when they want it. Discover all that's possible on the internet. Cisco Systems, empowering the internet generation.
In the late 90s, the internet was born. This new thing allowed you to send emails, take free telephone calls, and even have a company website. And companies like Cisco were at the forefront of offering these kind of internet services to businesses. Investors and analysts on Wall Street were so optimistic about the company that Cisco's stock price rose the best part of 900% in the run-up to the peak of the dot-com bubble. This put the stock price at a price-to-earnings multiple of 148.4 times earnings, and it quickly became the highest valued company on the planet at that time at $452 billion. And well, Wall Street were left holding the bag not long thereafter.
Bad day.
Bad day for you?
Another one, yeah.
The stock crashed 85% and hundreds of billions of dollars of market value disappeared. Frantic selling took place and losses compounded losses. The selling snowball effect started to take place and the dominoes began to fall. But why exactly am I telling you this? Well, some people are making that same comparison to Nvidia stock and a couple of others based on current market performance. But instead of being driven by an internet revolution, this time we're being driven by the artificial intelligence revolution. A new type of technological intelligence which is quite literally sending the markets to all-time highs, with arguably the same levels of optimism, excitement, and perhaps even a little bit of greed than we saw back in the late 90s during the dot-com bubble. In the last 3 years, Nvidia's stock price has risen 893%, with comparable stock price growth to that of Cisco back in the late 90s, which has resulted in Nvidia becoming ranked the second largest company on the planet today. And look, don't take it from me, analysts are making that same comparison between Cisco and Nvidia.
I think Nvidia will absolutely go down as the Cisco of 1999 here. In other words, a company that got a huge run up and will end up performing great with revenues and earnings, But at some point, the investors who bought it in these high valuations will end up realizing that it has to revert to a regular valuation. You can't get 60 times earnings to go to 80 times earnings and have that be a sustainable investment. Cisco in 1999 was $85. It's grown earnings every year since then, and yet it's at $50 today. That has nothing to do with Cisco underperforming. Nvidia is going to do fine as a company. It's that the valuation's too high, and when people buy into a bubble, they end up suffering.
But let's be honest, Nvidia aren't the only company that are massively benefiting from the AI play in the current state of the stock market. In the last 3 years, AMD has risen 119%, Broadcom up 286%, and Micron Technology up 75%.
When you're just looking at the price of something, you're not investing.
We can't just look at the price of a stock and justify it being a good investment, and instead we must look at the underlying fundamentals of a business to make that informed decision. Because as John Bogle once said, in the long run, it's always the fundamentals that drive returns. Those just following a stock price to justify an investment will be the ones that suffer, whereas those investors who are looking at the underlying fundamentals of a business will be the ones that won't. So let's dive into the fundamentals on Nvidia in a little bit more detail and benchmark them to how Cisco was performing before the market crash took place. Here are the headline numbers. Nvidia saw revenue growth of 265% year on year. Cisco's revenue growth at the time was 55.4%. Net profit growth for Nvidia was up 769%. For Cisco, 31.8%. Net profit margins for Nvidia are up 55.6% versus Cisco at 14.1%. Nvidia are quite literally printing money, and all of this translates into an earnings per share figure of $4.93 for Nvidia, but just 36 cents at the time for Cisco. From a PE multiples perspective, Nvidia traded at 72 times earnings versus Cisco at the time of 148.4. So what I conclude from that, aside from Nvidia seeing stock price growth, which is pretty euphoric, comparably, Nvidia are seeing 25 times bigger earnings growth, 14 times greater profitability on a per share basis, and a premium 51% lower than that of what Cisco had at the time. So I could argue that we're not really in the same territory as Cisco were back in the dot-com bubble. However, I will caveat this by saying this is all based on current and future growth forecasts. If, and this is a big if that I must labor on the point, if Nvidia's growth rates start to slow down, then investors could find themselves in trouble, especially if they've invested at these kind of price points. Because stocks underperform when expectations become bigger than the actual financials achieved. The Nvidia price movements actually make me think a little bit more about Tesla's stock price in recent times rather than Cisco's. An explosive run-up based on perhaps first mover advantage, huge levels of demand, along with huge levels of optimism for the company, and then growth rates thanks to bigger macro circumstances couldn't be fulfilled. As a result, Tesla's stock price is down 48% from all-time highs. The reality is stocks can't just keep going up in a euphoric fashion, and they will have to come down at some point. When that will be exactly, well, me or nobody else can tell you that. What exactly do you guys think? Let me know down in the comment section below. From my investments, about 70% of my holdings are made up of broader stock market funds. And right now we've got analysts coming out the woodwork saying that we could see between a 30 and 48% market crash, which could be on the cards as a result of this kind of AI-driven stock market bubble that we're currently in. And for those who watch me invest on this channel every single month, subscribe if you haven't done so already, will probably think I may have lost my mind investing into the market at peak market values. But before you do make any conclusions about my investment decisions, first, I wanted to share this bit of research that Schroders have put together. It says since 1926, of the 1,176 months since then, 354 of them, the market was trading at all-time highs. That's the equivalent to about 30% of the time. So there is a 1 in 3 chance that if you cost average into the market every single month, just like I do, then you will be investing in or around all-time highs. The study goes on to show the inflation-adjusted returns of US large-cap equities if you were to be that person that invested in the market at absolute all-time highs, and those returns were as follows. After 12 months, you would have received returns of 10.3%. After 2 years, about 8%, and after 3 years, returns of 7.6%. These are inflationary adjusted returns on the basis that you invested into the market at all-time highs. Now, naturally, there are some caveats to this because we have seen in the past prolonged periods of market underperformance. And not just underperformance, but negative performance, like the financial crisis and the dot-com bubble, which we've spoken about. But overall, market performance has always come back, and markets have always moved to achieve all-time highs again in the future. Now you might be sat there thinking, well, this could be the start of the dot-com bubble crash, and that if you time the market well enough and sold your investments, then you'd be in a position to capitalize. But the study goes on to conclude that if you were to switch to cash, if the prior month was trading at all-time highs based on a $100 investment in 1926, today that would be valued at $8,790. But here's the punchline. That compares to an investment portfolio value for the individual who stayed invested throughout that period of time, who would be sat on nearly 10 times that amount of $85,008. Now, I don't know about you guys, but I know what kind of investor I'd like to be in that scenario. So bubble or no bubble, crash or no crash, I'll be doing exactly what I've always done, which is to continually invest into the market every single month without fail. It's a long-term mindset that I have, absolutely regardless of what market commentators or market analysts are saying. And look, in the past 7 years, it's certainly served me well. And I've also been through a couple of bear markets during that time too, even at times where people were saying that markets were overvalued and overpriced. And perhaps they're right, because markets do eventually sell off. But that's nothing new. It's part and parcel of being an investor and just natural market cycles playing out. Ultimately, you have to zoom out, see the bigger picture, because right now is only just the start of something great. Now, if you did want to check out what's in my investment portfolio, then I'll put a video to that there, which you can click on now. And with that being said, I'll see you over in the next one.